Let's get more from Andre de Silva. He's head of Asia-Pacific Rates Research at HSBC. Andre, thanks for coming in. They're all facing the same challenges, aren't they? Effectively, it's inflation. It's also, in some cases, a rising currency too.
Right. Well, as of today, as you said, in terms of order sequence, you've got the Central Bank of Indonesia. But actually, for once, it's going to be a little mystery for central bank decision-making. The last time they raised rates was only the first time their cycle was February, and today we think they'll stand on hold. If you look at the backdrop of inflation, actually it's been quite well behaved. In the past 5 months now, we've seen sequential falls on an annual basis, or in terms of growth. So it seems that they'll be on hold. But nevertheless, there are some niggling doubts when it comes to that particular region. We've got Ramadan coming, and we've also got...
That's in August, I believe, isn't it?
That's correct, yeah. And typically that leads to like festival items such as food and clothing.
Well, the irony is, when you're fasting, that the price of vegetables go up in many countries. That's the odd thing. So
unfortunately, that's the case. That's the price you have to pay when you celebrate.
Every day.
But in every day, well, but I understand. And indeed, if you look across the other regions, that becomes much more apparent in others. And we'll see tightening, though, in the likes of the Central Bank of Thailand, for example.
Yeah, I want to talk to you about that. I mean, do you see that coming through because they want to assert their independence given the new leadership?
Well, I mean, they've already stamped their authority as an independent central bank for quite a while now, raising rates progressively. I think 6 out of 8 times they've raised rates, and tomorrow we think they'll deliver another one. The question is whether the policies announced by the politicians in the election, sort of the campaign trail, will be delivered. Now, given the majority that we've seen, that's more than likely. So the problem that the central bank has faced is that these are quite inflationary policies. So, for example, if I cite one, which is quite topical, and that's the minimum wage. They're talking about 300 baht per day. That's almost twice the amount.
That's $10 a day, roughly, isn't it?
Approximately, in terms of US terms. Whilst it seems relatively low, it does have a meaningful impact in terms of inflation.
Yeah, I mean, it's not just that, it's all those policies. I mean, they probably don't, the central bank doesn't probably want all this spending going on as well, with rice subsidies coming in as well, so that the farmers get, well, more money for the rice that they're growing, and also a tablet PC for every school kid as well.
Well, that's correct. They haven't told us what type of tablet PC, so I'm not going to give a measure on each one. But yes, that clearly is fiscal expansionary and certainly inflationary if that comes through. And net, as I said earlier, I think that's a possibility. So for us, the course of tightening is set in stone for Thailand. But I would say, however, if you look to the next meeting on Thursday and Bank of Korea, clearly that has much more of a global complexion.
Of course.
In particular, with the exports, they're very much reliant on that. You only have to look towards the non-farm payroll on Friday and suggest that has an impact in terms of car manufacturing, shipments, and sort of fancy electronic equipment. That might have some impact. But certainly they all like to be on hold, not necessarily for that reason, but it reinforces them being on hold for this particular month.
But they're all facing the same sort of things. Inflation, of course, is the watchword for all these countries right now. But, you know, many people talk about, well, inflation will peak in July or August, and it's putting it down to base effects. But that's not really the case, is it, quite often?
Well, certainly if you look at it from a core perspective. Headline, yes. There are certainly evidence that we're seeing that coming down in some regions, or at least on a forward basis. But that doesn't necessarily reflect underlying inflation. Again, I stress, let's go to the Thailand example. There they have a direct targeting on core inflation of 0.5 to 3%, and it's already breaching the top of that target. Korea, core inflation at 3.7%, highest since May 2009. So yes, core inflation is still an issue and needs to be tackled. That's why we think further tightening is likely in the second half, even if growth is subsiding somewhat and headline is also subsiding. Very
quickly as well here, you know, Andre, we have QE2 coming into an end at the end of June, and you know, that liquidity, that wall of liquidity should be removed. What impact does that have, very briefly?
Well, I think it's a little bit of a misnomer. I understand the concept in terms of defined deadline of 30th of June, but in reality, low long-term bond rates and the Fed on hold still means cheap money chasing returns.
I want to talk about the fears of Spain and Italy going the way of Portugal or Ireland or Greece right now. That's what we saw yesterday on for fixed income markets. Quite a move there. I mean, Italian bonds going up by that amount, yielding what, just shy of 6% now?
Well, that's correct. I mean, I moved from London to Hong Kong a year ago, hoping I could avoid all this sort of questions about European sovereigns, but if anything, it's intensified since, and it has a significant impact globally and in the region of Asia. But Italy, yes, I think this is beginning to be something of a very much dark order in terms of scale. We all well know about Greece and the possibility of some form of debt restructuring, but we had the spectre of even the officials now recognising default in some shape or form, and that's been the catalyst now to focus on contagion, including Italy.
Now, Italy, I mean, why Italy here? I mean, 125% GDP here, now the debt to GDP ratio, that's not that bad in the scheme of things, compared to some.
Well, yes, but it's sort of relative. If you write off some of those that already have been bailed out, would like to get further bailouts, it's who's next. So, yes, you're right in terms of comparison to Greece, Portugal and Ireland, but in comparisons versus Spain or Italy, Italy fares worse in terms of the dynamics.
If we look at actually total debt in Italy, we're talking about the third biggest pile in the world after Japan and the United States.
Well, yes, indeed, 1.6 trillion in euros or 2.2 in dollar terms. So that's quite a big pie to finance.
For a country that size as well.
Yeah, and what you mentioned, that number 6%. It's more than the bellwether we've seen elsewhere. Whenever there's been sort of 6% on a sustainable basis, 1 or 2 months in Eurozone, that's been a trigger point for a bailout. So I know it's simplistic to think about that, but it's something in perspective. And the problem is all the sort of mechanisms available within Europe at the moment in time do not have the affordability to bail out Italy currently.
No, they can't, I suppose, given what we have at the moment. But the relevance to Asia, I guess we also have to look across the Atlantic and look at the relevance of the spat between the Democrats and the Republicans over raising the debt ceiling at the start of August. Now, where are we with that, and how important is it? Because if we don't get it, we could have a default, which could, that's what the threat is, we could get a downgrading in ratings, and it means China's sitting on, well, paper which is, well, not worth a lot.
Well, there is a risk of a perfect storm in terms of escalation concerns and sovereign risk in Europe, and then US debt problems. But in reality, even if nothing materialised of substance over the weekend, even though there's expectations in the US, I do think there will be a sort of 11th hour deal. And reality, in terms of financing the debt situation, there's a realisation, I'm pretty sure, by politicians that they can't suddenly turn off the taps in terms of Treasury issuance and coupon payments. If anything, they're more likely to turn off the lights of departments, as they've done in the 1990s, because we need a fully functioning financial markets. So in reality, I do think they'll muddle through, and the focus will still, therefore, be, as it is at the moment, European sovereign risk.
Yeah, well, you know, the bond markets, and we look at bond investors, we look at how sanguine the reaction is for these debt talks on the US Treasuries. But when we look at the spike in Italian and Spanish banks, you see real skittishness there. Discuss.
Well, yeah, if you look at 10-year treasuries in the US, they've dipped below 3%. They've retraced quite dramatically from the 3 3/4 we've seen earlier part of February and March. So regardless of those, your questions earlier about QE2, it doesn't really matter. If anything, it's about low growth, indeed soft patch, and risk aversion. That's what's dominating it. It's not about financing the debt at the moment. But I do think this is a reprieve for the US. Come 6 months or 12 months down the road, and we're still tackling these question marks.
Well, Barack Obama says he doesn't want a short-term solution, but invariably these end up to be just a band-aid.
Yes, although I think the consumer reaction is still going to be fairly progressive, because even if you promise expenditure cuts and tax increases, depending on what that mix may be, 5-10 years down the road, they'll anticipate that. So the economic ramifications are still be felt early on, and I don't think that's represented at the moment in time in market sentiment.
Andre, great to see you. Andre de Silva there from HSBC.